Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, rate strategist, and I'm joined today by our global market specialists, Giovanni Zanni and Nevruzi. Before getting into today's discussion, I just wanted to quickly remind you to hit the like button and don't forget to subscribe so you can get the latest episodes as soon as they're available. And since I haven't been reminding any of our listeners recently, if there are any questions that you'd like to ask me or any of the other Bondcasters, please don't hesitate to drop an email to bondcast@natwest.com. Okay, Jan, I'm going to start with you this week because we've had I think I said this last week actually, but we've had the US really leading the way in terms of global fixed income moves, particularly at the beginning of the week. So let's start with the inflation data, because I'd say that's what's created a bit of volatility. I should just caveat before we get into today's discussion with listeners that we're recording this on a Wednesday, obviously ahead of the shortened holiday week this week. So inflation data has kind of been the big market mover, which really created a turnaround in fixed income markets after a big sell-off on Monday. I guess before we get into the details of the print and what this means for the Fed, can you tell us, how that really compares to market expectations and what it was that was really driving the big move lower in yields yesterday?
Yeah, of course. So on the headline side, which incorporates more volatile items such as food and energy, it pretty much came in along, inflation came in along expectations. It was a pretty large 1.2% month-on-month increase. That was widely expected because the war in Ukraine, we have seen commodity prices go up, energy prices go up. So the effect of that, while it's hard to estimate exactly, it is well known that it would have boosted the headline figure a lot. On the brighter side, the core component, which strips away these volatile food and energy components, it was more stable. It came below expectations. So that was at about 0.3% on a monthly basis compared to consensus view, which was around 0.5%. So with that in mind, what does that mean? Was it a fully broad-based decline in inflation? No. Is it enough to bring back the kind of like the transitory discussion of yesteryear? Not really, but there are still components like rents, which make up the largest piece of inflation calculation. They moderated more than expected, rising by only 0.4 versus a forecast of 0.5 percentage point, and below the 0.6 in February. So that has perhaps started a downward trend. Airfares and lodging, perhaps as expected, were much firmer than expected, reflecting these kind of both rising input costs and leaving the Omicron wave behind us as people went out more, mobility indicators picked up. And finally, I guess what used car gives, used cars also takes away. This time we had a sharp drop in used car prices at negative 3.8% month on month, much larger than estimated. So that in itself shaved off about 0.2 from the core CPI. Otherwise, it could have been flat versus expectations. But just like towards the end of last year, used car prices were a large driver of these huge inflation prints. It's in a similar way now they're causing the downturn, I suppose. So that was the real main difference. There wasn't a massive broad-based. Services still showed a decent increase, but it's probably the first time where we can more comfortably say, okay, this is moving the direction we want it to be. 3.3% month on month is not great, but compared to where we were, I think the Fed will take that.
So I guess that leads me nicely on to the next discussion point then, which I think is really what this means for the Fed. This is the last inflation print that we will have before the May meeting, I think, correct me if I'm wrong. And we've been talking a lot about the prospect for multiple 50 basis point hikes. We've just revised up our forecast in the last couple of weeks to have 3 consecutive 50 basis point hikes over the next 3 meetings. Does this really change anything for them? Does it derail the likelihood of, hawkish rhetoric over the coming weeks, derail the likelihood of 50 basis point hikes? How are you thinking about this in the context of the bigger picture for them?
So since I said it's good news for the Fed, let me start with what I think it means for them. What I think it means is they're going to use this as their main defense into the next meeting. You're right that this is the last inflation number before the May 4th meeting. So they're going to use that. They're going to point out, see, inflation has been decelerating. This is good news. They're probably not going to dig in too much which component drove what, but they're going to point out the downward trend. So as far as monetary policy implications, what I think it means is the odds of another hawkish delivery like we got in December, like we got in March, have fallen dramatically, at least from a forward guidance angle. So like I mentioned, it's hardly enough to bring this transitory narrative, but the core reading is arguably the first inflation figure in about 6 months that kind of leans into rather than against the idea that inflation will eventually normalize. So that part of the distribution where the Fed would just come off again, kind of like ad hoc markets, I think has been cooked away. But moving on to what the CPI report wasn't for the Fed, I don't think it's going to change anything in the trajectory for the May meeting. We expect a 50 basis point hike, including an announcement for quantitative tightening. And at this point, I'm more inclined to say that it doesn't change anything for the June meeting either, because I would think the Fed would like to deliver a sequence of 50 basis point hikes as opposed to a one and done, we maybe made a mistake type of hike that would perhaps send the wrong signal. So does that mean that inflation has peaked or no? We don't know. The Fed doesn't know either. They're going to use that in support of their points, but we think the path has not changed. As Chicago Fed's Evans said earlier this week, a 50 basis point hike is highly likely at the next meeting. That feels a little hard to walk back. And finally, the Fed will need to see a series of sustained improvements as opposed to a one-off improvement before they kind of go into a large shift in trajectory.
Yeah, I think that makes sense. So that kind of broadly covers off the front end of the curve. But what about the longer end? You know, we discussed on this podcast for the last couple of weeks how you've sort of turned a bit more neutral on US rates, particularly at the longer end of the curve. You put a year-end target of 2.5% on 10-year treasuries. And we're now, you know, with this kind of global sell-off that we've seen over the last couple of weeks, we're now well through that target. So, you know, you're more than neutral if you still have a 2.5% target for the end of the year, and actually starting to look a little bit dovish there. So how are you, or bullish rather, I should say, so how are you thinking about, I guess, longer term rates from here then?
Right, so longer term rates, both even not so long, like even intermediates and kind of like the belly of the curve, I think suffered from the fact that there was an overwhelming view that rates are going to go higher. And there was not a single investor willing to fade that or try to catch this falling knife. I think now that easy slide might have been axed, so to say, because now there is a narrative why you might not want to be constantly short rates, and that is there has been perhaps a shift in trend in inflation, which could put the Fed in a different path. We're not there yet, but that question mark has popped in people's minds, and it will stay there until we see the next sets of data. And I think this kind of relentless selling in fixed income space might come to an end. I'm not saying there's not going to be any moves higher in yields, but a lot of the time over the past 2 weeks, at least, it was just 10 basis points higher in yields without any apparent catalyst. I think those will be much more limited going forward. And now rates have pulled back after yesterday's CPI. And we have been of the view, like you said, that the markets have priced in the right amount of tightening. And until data proves it otherwise, we shouldn't expect to see any kind of more upward shift in yields. And I think that's kind of what is happening. So we are, I guess, by function of forwards and our year-end targets, now a little bit more on the bullish side. I still don't think it's the risk reward makes an outright case for going long, but I'm leaning more towards that direction than maintaining shorts, which are extremely costly now. So yeah, that's kind of where we are on rates. And since it's a holiday week, I'll try to take this a little bit differently, and let me ask you some questions. And and as you said, I guess the U.S. rates have kicked off the kind of like the shift higher in yields. And if I remember last week, you talked about the kind of like your bearishness in gilts, and as quantitative tightening kind of comes back into focus, we have already priced in about 15 bips higher than last week. So what do you think? Where does this go from now?
Yeah, you're right. We did discuss last week, with the Fed bringing into focus this kind of theme of quantitative tightening, and obviously it's going to be very important, we think, in the UK and in Europe as well. But I guess unlike how you've just spoken about US yields so eloquently, we actually still think there's further to go in gilts and on the European side as well, but we can get to that later. Readers of our kind of strategy notes will know that we published a new gilt target last week of 2%. When I started writing the note, it was a little bit further away than by the time I finished. But as of today, I think we're still about 15 basis points away from that target. So we still think that there is scope for upside pressure. And I guess the point really for gilts at this point is that most of that upside pressure we think is being led by just this kind of upward momentum globally in yields. It's a combination of that, and I suppose some upside risks to what we see as kind of fair value in our gilt model. So our gilt model looks at more, I guess, domestically based factors, so things like inflation, the stock of APF, and they all suggest that, and bank rate as well, they all suggest that actually fair value of gilts is lower than where we are now. I would say about 10 basis points lower, about 175. But once you overlay this kind of global shift higher in yields with the Fed moving more hawkishly and this just significant upward momentum that we've been seeing, coupled with the fact that on a lot of the factors that we use in that fair value model, we see, I guess, risks to the upside in terms of yield. I think we've baked in very kind of cautious assumptions around how the stock of APF, say the Bank of England's holding of government bonds, might reduce over the next year, i.e. we haven't baked in any quantitative tightening assumptions for 2022. We have quite dovish compared to market expectations view of the bank rate. We only have 2 25 basis point hikes priced in for the rest of this year versus the market, which has more than double that. So all of the kind of factors that we use to feed into this model also have upside risk on them as well. So even though our kind of domestically based fair value comes out at 175, overlaying that with other risk factors, and I think we're quite comfortable with a target of 2% in 10-year yield. So still further to go, but agree with what you've said, that perhaps the speed of the move and the volatility of the moves that we've seen of late is not here to stay, but still some upside in yields.
Right. Yeah, that makes sense. And how about on a cross market basis? A lot of the themes that investors have been talking about recently has been the outperformance of gilts. Do you think that continues?
Yeah, I mean, gilts have outperformed a lot, and I think a lot of that was driven by surprising hawkishness from the ECB back in March when they really revised down their taper path. And then we also had, I guess, this kind of upside surprise when it comes to benefiting gilts of less than expected gilt supply announced this year at the spring statement back at the end of March. So those two factors, I think, have been driving the gilt outperformance in this kind of global shift higher. Is there further to go? Yes, probably. At the longer end, not to go over the discussion that we had last week, but this whole idea around the net duration that the market has left to absorb once you net off central bank purchases, that delta in 2022 versus 2021 is much more significant in the euro area than it is in the UK. And also at the front end, if we talk about the very, very front end of the curve, really just looking ahead the kind of next 9 months to the end of this year, for example, where we have, say, one hike penciled in for the ECB, at 125 basis point hike penciled in for the ECB in December, the market has around 2, whereas, like I was saying, for the Bank of England, we expect only 50 basis points worth of hikes, whereas the market has more than 100 basis points priced in. So there's more scope for dovish repricing at the front end, I think, when it comes to the Bank of England versus the ECB as well, which I think can drive some outperformance of front end rates as well.
Right. And I've been talking a decent amount about inflation, but the US is not the only place where we had inflation. The UK did, and I guess leaves you with the tougher job of explaining why we got a surprise to the upside, not to the downside. So where does this, can you talk about that, and where does this leave us about with the BOE?
Yeah, we've essentially had two opposite prints this week in inflation. You know, we had the US inflation, which drove quite a significant rally across fixed income. And then we had UK inflation this morning at 7 a.m. and the whole like global fixed income space opened up significantly weaker. So, you know, different to what we saw in the US. In the UK this morning, we had upside surprise on both CPI and on RPI. But I think there's probably three key takeaways from that for markets. The first is that, you know, the upside surprise was pretty broad-based. 8 out of the 12 components added to inflation. So it wasn't necessarily driven by one sector alone. Having said that, restaurants and hotels added a kind of sizable upward contribution, and this is pre-Easter data. So, you know, along with the fact that we've obviously had rising energy prices too, that suggests that actually the peak is not in yet, and there could be further upside pressure from that next month. To put that into context, we think that the peak is in April next month. So more inflation to come in the UK. But I guess the final point that I make, which is most important for markets, is that the Bank of England had already kind of revised up its inflation profile and where it saw the peak in its forecast in the March meeting versus its February meeting. So although we've had this dovish shift from the Bank of England, that has already kind of encapsulated some of this rise in inflation, and won't necessarily kind of, this latest print won't necessarily kind of throw them off course in terms of them leaning more on the dovish side of this kind of latest crisis and being more cautious on the growth outlook rather than focused on the higher inflation prints. So it doesn't change our call for this year to have 2 25 basis point hikes. I feel like I've said that a lot of times on this pod. 2 25 basis point hikes, one in May, one in August, and then potentially an announcement of quantitative tightening in the second half of this year. So I think I've talked for long enough then on the UK. Let's move on to the Europe and the ECB. Now, usually it's Jan who gets this short straw with US data, but Giovanni has the real short straw this week, in that we're recording this on Wednesday, obviously ahead of the ECB meeting tomorrow. So I'm going to try and not pin you too much to what your expectations are for tomorrow, because I imagine that will already have happened by the time most of our listeners are listening to this. But perhaps we can just talk more broadly, I guess, about the kind of ECB reaction function that you're thinking about for the rest of the year, I guess, in face of, you know, high inflation but slowing growth risks, and particularly with the ECB. You know, I think that's almost the more interesting central bank at the moment, because it seems to be the one that's most split in terms of views. You know, you have members of the governing council at each end of the spectrum that are leaning either on the more dovish growth side or the more hawkish high inflation side. So what are you expecting really from the rest of the year from the ECB, and how does that compare to consensus or market pricing for those things?
Well, first of all, you said divided, and that's absolutely the case. But you know, if you think about it, it's really mission impossible for monetary policy in this situation, because you mentioned that the stagflationary shock, this fact that inflation is so high and risk on growth are also pretty present. But the other element, which is really very strong, is the fact that you have such a big uncertainty on so many levels, no? So it's the unknown unknowns, if you have to quote Rumsfeld, or the Knightian uncertainty. So it's something very profound. And so in this context, it's really, you know, very difficult for monetary policy. Inflation is high today, so they should react to that. It's their target, but at the same time, we know that it's 2/3 driven by energy directly. And then if you look at core inflation, you know that also there are some indirect effects. So the real inflation is probably lower, but you know, then you could have the transmission to wages, inflation expectation. We're still not there. We still haven't ignited that element like in the US to some extent. But you know, we are at the cusp of that, so that's also an uncertain element. And then you have growth, which is about to decelerate in Q2. I think it's pretty clear. But how much? You know, what happens to the situation in Ukraine is definitely very relevant to the confidence of consumers, especially in Europe rather than in the rest of the world. And then the underlying element is that you have, a better situation because of normalization from Omicron. So big uncertainty on all these levels. The ECB cannot be dovish, but can they be very hawkish either? So I think, just for tomorrow, the idea is that they will probably keep the same guidelines and the same guidance. And over the next 12 months, although we have some rate hikes in the central scenario, we have 25 basis points at the end of the year, and then few next year. The idea is that we're still in a difficult situation, and a situation that the monetary policy on its own cannot solve. So we need to have more clarity on this uncertainty, and fiscal policy must be also part of the solution, which is what's happening, by the way.
Another element, I guess, that we have talked about a lot, in notes, and I think even on this podcast before, is with regards to peripheral spreads, I guess, and euro area fragmentation. And we've been of the view that reinvestments can be very important with, using the flexibility inherent within the PEP reinvestments, which are still going to be sizable as, PEP's now wound down. But we've also been talking that they could go a step further than that. They could introduce some kind of anti-fragmentation, peripheral backstop type tool. And markets' minds, I think, were focused on that a little bit last week when we had this ECB sources article from Bloomberg to suggest that this was something that they were thinking about. What's your, I guess, latest thoughts on that? Is that anything you expect them to address either tomorrow or in the coming meetings? And if it is something that you're expecting in the kind of near-term horizon, what could this tool really look like?
Okay, so my sense is that it's not something as imminent as, this week. Also because if you look at spreads, they are widened, but not to extraordinary levels. So the fact they're still relatively well behaved can give a little bit more space for this instrument. But at the same time, we've heard not just these Bloomberg sources, but also Lagarde talking about it recently, Lane talking about it recently. It was in the speeches of Villeroy already a few months ago. So definitely they're working on it. There's something that is being concocted, prepared on that front. How it would look like, I think it would be just a contingent instrument, like a PEP, contingent PEP with some elements from the OMT. And it would blur a little bit this idea between the end of QE before starting interest rate rises, which I think it makes sense in that context. So they can justify it. It's not new QE in a defined amount. So it would be in that form a way to bring together probably the hawks and the doves in an instrument that they can agree on. So yeah, that would be my visualization of the instrument.
Well, I hope we're not proved right or wrong as soon as tomorrow then. Just finally then, away from the ECB, because this week has also, well, I guess at the beginning of this week, the main kind of news in Europe was the French elections. Markets were nervous heading into the first round of the French elections, given the narrowing in the polls between Macron and Le Pen. But Macron ultimately did better than expected in that first round, and markets were quick to price out that political risk really on Monday. Le Pen also did better than expected, though really in the first round, the polls would have suggested leading in. So is that right for markets to have kind of quite so quickly priced out that political risk? And what will you be watching over the next couple of weeks as we head into the second round of votes, and what are you expecting there? Sorry, I realize that's like 5 questions in one, but hopefully you got them all.
Okay, sure. I mean, I kind of agree with the market view that the results were a little bit better than expected for Macron. Not just because he had a slightly stronger percentage in the end, but also because the higher number from Le Pen was compensated by a lower number for the rest of the far right representatives. So I think that's quite important. If you look at the share of votes, you're basically just under a third for the far right altogether, and then you have the left that has another a third, 33%. So and of this, I mean, it's more likely than not that they will be voting for Macron or not voting for Le Pen. So I think that chances are higher for Macron for sure. Then of course you are in a situation where you don't have the same gap that you had in 2017. You can always make mistakes. There could always be an accident. So I'm not completely relaxed at all about this vote, and I'm sure that Macron isn't either. So so what to watch? The way that the campaign is conducted is clearly one. Macron has already said that he will incorporate some of the requests or pledges coming, especially from the left side, on climate change, on environmental policy, and he might also revise a little bit his pension changes that he had announced. So that's something that could help. He's also insisting more than before about Le Pen, the global situation, the global context, geopolitics, which also is something that should win him some votes. The latest polls are showing 54 to 46, 53 to 47. So an advantage for Macron, but again, not super comfortable at all. So what am I going to watch? Of course, the polls, and then there will be a debate on the 20th, and that would be the relevant one. It was the very relevant one in 2017. Le Pen didn't do well. I think she'll do better. So again, a concern for the votes, but these are definitely a thing to watch. The last thing I would say is that more than in 2017, Mélenchon has insisted on not giving a single vote of his voters to Le Pen. So it has reinforced the message, which I think it's important. And actually, many of the people who voted for Mélenchon did it for a tactical reason, to get someone from the left in the last round. And my guess is that some of them, at least, are more center left rather than radical left. So that's another point of hope, let's say, for Macron.
Okay. Lots to watch then over the next couple of weeks, and I'm sure we'll be talking about that again on Bondcast, if not before, but at least after the debate before the second round of votes, which, as you said, is on the 20th. And just a reminder for listeners, the second round of the votes will be on the 24th of April. But we will discuss all of that again closer to the time. So thank you, everyone. Thanks, Giovanni, for joining. Thanks, Jan, as ever. Just a reminder to our listeners, if you liked today's episode, don't forget to hit the like button and subscribe so you can get the latest episodes as soon as they're available. And we'll chat again next week. Thanks.